As we've been reporting today, the U.S. trade deficit widened in November to $36.4 billion, a jump of almost 10%. Joining us now for a closer look, Peter Boockvar, equity strategist with Miller Tabak. So, Peter, tell us what the trade graph tells you about what's going on with the broader U.S. economy.
Well, the number being higher than expected, it was because we saw a bigger drop in imports. Bigger drop in imports than we saw in bigger rise in imports than we saw in rise in exports. That's what got it to move up, and that could alter fourth quarter GDP estimates downwards by maybe 1/10 to 2/10, with all else being equal. But it's still down by almost half from the peak. But we need to see going forward, in order to see a continued downtrend, is a bigger pickup in exports relative to imports.
With this humongous problem, consumers retrenching in this horrible environment for new jobs, how important is the U.S. export industry to our growth? You said that this number might shave off a few tenths of a percent off GDP.
Right. I think we're going to see a slowing contribution from the U.S. consumer to GDP over the next at least 5 years. In order to offset that, and more so, we need to see a pickup in exports. The U.S. needs to make more of what the rest of the world wants.
And what is that? What are some of these in-demand exports?
Well, I mean, it can be 85% of the world's population is in developing markets. We need to make things that they want, whether that's instead of shipping, creating factories overseas, having them here. We need to lower the cost of doing business in the U.S. That will incentivize companies to build things here that we can then ship out. That is the key to our growth over the next 5 to 10 years, and hopefully we can work on getting that done.
Peter, does today's number mean that manufacturers, wholesalers, and retailers are going to hold on to higher levels of inventories now?
Well, inventories are still dropping. We're still seeing drawdowns in a lot of the numbers. We're not actually seeing increases in inventories yet because end demand is still very uncertain. If you look at the NFIB Small Business Optimism Index, more small businesses wanted to cut inventories further. So everyone wants to be lean in a still very uncertain environment.
Well, with the rise in U.S. imports then, can we then take that to mean that at this point it's showing signs that companies are going to start picking up spending?
Well, hopefully. Part of that rise in imports also had to do with end-of-the-year holiday shopping that ended up being a little better than expected. So we're going to need to basically see a follow-through. But we need to increase that export side of the equation. That is the key to healthy U.S. growth, and that's going to be key in offsetting the retrenchment that we're seeing in the U.S. consumer that I expect to last many more years.
Weave in the China story for me, Peter. Of course, China, the news today, trying to cool off its own inflation pressures and potential asset bubbles, demanding higher reserves. So does that mean China will also taper off its imports of U.S. goods?
Potentially, but I think China really doesn't want to slow growth. They understand how fragile the economy is. They just want to try to quell some of this inflation pressures. They saw massive loan demand in 2009 as part of their stimulus package that helped to generate growth. They're in the process of trying to slow that loan demand down, and today's moves about raising reserve requirements and also raising the yield in some of their short-term bill auctions, I think is trying to do that. But they're trying to draw a fine line, again, because they still want healthy growth. They just want to take the inflation pressure out of the equation.
And what does that mean, though, for the U.S., because markets are lower largely because of this news out of China that's weighing on commodities?
Well, it has a huge influence. I've been saying for a while that in terms of global growth, China is the most important country in the world, and they are going to remain that way for a while. They brought us off the brink in November of 2008 with their stimulus package, and they were the precursor to the global rebound in 2009. And I think we have to watch their moves engaging global growth in 2010, particularly with emerging markets that sell a lot of goods to them and produce commodities that China wants.
Peter, let me ask you about the falling dollar. What does that mean for U.S. sales overseas? I would guess in the aggregate it means that they're going to rise, but at some point factories and the economies will be the beneficiaries of that, won't they?
Yes, there's no question from a competitive standpoint we benefit from a weaker dollar. But on the flip side, U.S. investors and global investors don't want to hold U.S. dollars if the U.S. dollar keeps depreciating. So like a sieve with sand coming out, you're seeing a bleeding of U.S. dollars going overseas because of this weakness in the dollar. So we're starving ourselves of capital by embarking on this weak dollar policy, and it will more than offset any benefit we may get from a help to exporters.
Peter, we have a little bit more than a minute left. I want to ask you about the Fed, particularly about interest rates. Would a rise in interest rates create a pothole on the road to recovery right now?
Well, it depends to what extent. I think if the Fed raised to 75 basis points, which would be up 50 basis points from where they are now, over the next 6 months, it would not be the end of the world. The U.S. bond market is in the process of already tightening for the Fed, so when the Fed does raise, they're just going to be following the bond market. I think keeping rates at 0 is a failed policy. Cutting rates to 1%, which created the bubble, in my opinion, that Greenspan did, was a failed policy. And anything that can normalize interest rates relative to the market demand for money, I think we'd all be much better off over time.